Stocks are mixed just ahead of the closing bell on Wall Street as investors await now key inflation data on Wednesday. For more on what to expect from that April CPI print, we want to welcome in Jim Smigiel, CIO. Jim, it is good to see you. So markets, a look at the major averages, kind of modest moves today, Jim, but we do have that big inflation print on Wednesday. CPI is on deck. What do you expect to see there, Jim, and how important is that for the market?
Good to see you, Josh. Thanks for having me. I'll start with the latter question first. It's very, very important for the market. All eyes definitely focused on this number. We had 3 hot prints in a row, as most investors are aware, and the Fed is really running out of room here in order to deliver the cuts that I think most investors would love to see and that the FOMC wants to deliver themselves. So one data point doesn't make a trend. So they're going to need a few more after this one, even if this one does come in light. I will say the whisper that we are hearing around Wednesday's numbers that we should expect slightly weaker. But even if we do get something slightly weaker, you're still looking at a 3 handle on probably both headline and core, still leaving the Fed in a pretty tight spot if they would like to see rate cuts coming in calendar year 2024.
So, Jim, how you then sort of position yourself going into that? Do we just assume that rates are going to stay where they are for a little bit here and sort of strategize, accordingly?
We're actually taking a little bit of a more pessimistic stance as it comes to rates. We are a little bearish. We do expect 10-year in particular to try to maybe retest that 5% level that we saw about a year or so ago. And even at the very least, get that 20 or so basis points back post the last FOMC press conference, where really what Chairman Powell went ahead and did is took any talk of a rate hike completely off the table. So, with the trend that we've seen recently, a bit of a reacceleration in inflation, the market began pricing in the probability, however small, of a potential rate hike coming in here. Powell went ahead and squashed that, and we had the 10-year kind of rallying below 450. So, from a positioning perspective, we're taking, relatively modest moves at the margin, but our view is for rates actually higher between now and the end of the year.
Jim, we talked about that CPI print this week, but another date on the calendar for investors is Nvidia. Their earnings are coming up as well. Could that be a catalyst for the market, Jim?
I think it absolutely could be. Look, if you take a look back the last 12 months, maybe even 18 months, Nvidia is in one way kind of all that's really mattered. I mean, as much as we talk about the Magnificent Seven and whether that's turned into the Fab Four now or the Terrific Three, who's ever left standing, Nvidia is clearly the juggernaut of the bunch. So you're trading at 40, 50 times kind of forward earnings. When we look at that as a possible event, we're looking at that relative to the VIX. So equity volatility, we think, has been unusually low given everything else that's kind of happening in the world. And just given the overall importance of this one individual name, the earnings, the percentage of investment, the percentage of earnings that this one name, the percentage of performance, I should say year to date, that this one name has delivered not just year to date, but also in 2023, a lot of importance riding on this one number.
Jim, talk to us about utilities a little bit, because that's an area that has been rallying. I believe you like it as well. Why, and this is not typically a group that does well when rates are high. Do you think it's going to be able to continue to run here?
Yeah, we're a little skeptical on that. So we're kind of neutral utilities. I think it's a great point, Julie, because this hook in the utility performance, if you track the chart on Yahoo Finance, you can see that it's been pretty recent rally there. And I think a lot of that has to do with this kind of dovish stance that the FOMC came out with. So everybody knows we started the year with these huge expectations, 6 rate cuts kind of priced in, or investors trying to bake in the cake for 2024. That's been walked all the way back. And now we put a few more back on thanks to the dovishness from the last press conference. And I think utility is always a bit of an income play. Whenever there's expectations for lower rates, you would expect utilities to kind of hang in there. And that's what we've seen recently, especially with that kind of strong performance post press conference.
So, Jim, you said you're a bit skeptical of utilities. Where do you see opportunity right now, Jim? What sectors look attractive?
Yeah, it all kind of goes back to the same point, which is kind of our view for rates. We think rates head higher. We think inflation is going to be stickier for longer. And if we have that view, that's going to probably, not too surprisingly, lead us into the direction of more kind of value type names. And what represents kind of good value right now? It is financials. Good conversation in the last segment on financials. Very, very diverse part of the market for sure. Investment banks, money center banks look pretty attractive right now. Forward earnings in 12s and 13s and 14s relative to the broader market at 22. We're also looking at things like materials and energy. So things that really aren't overly geared to an interest rate kind of move, or at the very least are going to benefit if we do see rates kind of drift higher from where they are today.
Jim, thanks so much for joining the show today. Appreciate your time.
Thank you.